Here we go. All right, I'm back in chapter 10. All right, so we started off chapter 10 with all the current liabilities, and then we have two major types of long-term liabilities. One of them is bonds, corporate bonds, and we're going to start with that. Explain what bonds are, why they're issued, and what types of bonds there are. And then we are going to talk about long-term liabilities, which would include things like mortgages. So if you ever buy a home or make a major purchase and you sign a mortgage, a typical mortgage is 30 years at a fixed interest rate. And so calculating how companies deal with mortgages, and it'll help you understand mortgages as well. But we're going to start now on bonds, and then we're going to, I'm going to give you some time at the end of class to be in your teams. All right. Okay. I don't know about you, but when I took the second course of accounting, I had no idea what bonds were. And it just seemed like a black hole that I still didn't understand for years. And then I finally understood what they were. But essentially, it's a loan. But it's a publicly traded loan that companies use. They use them so that they can raise money, also known as raising capital. Okay. And by the way, at any point in this process, please interrupt me with questions. I value your questions. And this is an area of finance that we don't usually think about in normal terms. Okay. Now, earlier, 20 minutes ago, I was talking about risk, and companies issue far more bonds than they do stock in terms of dollar amount. Okay. This is the primary way companies raise money. And people buy the bonds. We call it buying the bonds. When you loan the company money and you get the interest, and the interest is paid out the interest is paid out semi-annually, but for the purpose of this class, we're going to treat it as annual interest, because I'm more interested, that the textbook writer is more interested in having you know the concepts versus having you do a lot of extra calculations. Okay, and I tend to agree with that. Okay, so the company borrows money and issues the lender a bond. I mean, you could actually have a paper bond. Everything's electronic these days. Okay, the name of this contract is called an indenture. It's a funny word, an indenture. And the company promises every year, let's say every year, to pay you interest. Okay, so they're not holding the interest for the life of the loan. They're paying it out as they go. Okay, for a lot of people, this is a guaranteed income. Every 6 months, every year, this is my fixed income. I bought this bond, it's paying 6% a year. I get 6%, I can count on it every single year. And so for a lot of people, that is a source of income, particularly if you're a retiree and you have that money coming in and you can count on it, okay? So the interest is being paid over the life of the bond. So let's assume it's annual. So a 5-year bond is going to pay interest year 1, year 2, year 3, year 4, year 5. At the end of that 5th year, they're going to pay you back the bond principal. Okay. Everybody with me so far? What's weird about this is, unlike other kinds of notes, this is not an individual agreement with me and Amazon or me and Microsoft. It is being traded in the public bond market, just like it were a stock. Okay. Bond prices go up and down. So you buy a bond, you're guaranteed an interest payment, and you're guaranteed the principal that's on the face value of that bond. But what's weird is that the bond prices actually fluctuate. They go up and they go down, okay? Which doesn't sound like a loan at all. It sounds more like a stock, okay? All right, so I got a little nutty. I started pulling all these old bonds. I didn't get Daniel Craig. I'm sorry, I just don't think he's a good bond. You guys can all agree with me. It won't affect your, disagree with me. It won't affect your grade, but all right. All right. This is a picture of a bond. If you look closely at it, in the old days, they actually used to issue a bond, and then they would issue these coupons that were attached to the bond, and you would tear off the coupon and you would go and get your interest payment. Okay, now it's all electronic. Okay, but this is a face value $1,000 bond. If you look closely, you'll see 20 years, 3.5% interest, issued, it's due 1976. So if it's 20-year bond, it was issued 1956. Okay. Right. So every year the bondholder gets $35 for this bond for 20 years. Okay. If the company pays semi-annually, they get $17.50 twice a year. Okay. So why would companies prefer bond financing versus stock? Okay. If a company releases more stock, okay, let's say the company needs more money. They've issued 100,000 shares of stock in their IPO. And does anybody know what IPO stands for?
Initial public offering.
Yeah, and what does that mean, Bryce?
It's just when a company goes publicly listed for selling stock.
For the first time, right? So let's say their initial public offering, they sell 100,000 shares of stock for $10 a share, and they raise $1 million. Well, let's say down the road, they say, well, we need more money. We want to build more buildings. We want to open more stores. We want to, like, if it's Starbucks, I want to earn more. I want to open more stores. I need more money. And so they say, let's issue more stock. We issued 100,000 shares. Let's do second round. So, oh, JR, no, you're not interrupting. We're on page 47. Okay. So I don't have notes except for the top of the page. You could write some notes in where it says benefits of bonds. Okay. So a company can issue more stock. The stockholders have to vote and agree that they want more stock issued. Okay. But what that means is, let's say they want to issue 20,000 more shares of stock. What that means is you have 20,000 more votes. Okay. If instead they issue bonds, they'll still have 100,000 shares of stock outstanding. They'll raise the same amount of money. Okay. Does that make sense? So bonds are preferable, then they don't risk losing more control. Okay. Interest expense is deductible. So company's going to pay less taxes per year. So that's a tax savings. Okay. So earnings per share could be higher. So remember how we calculate earnings per share? We take net income divided by number of outstanding shares. So if your outstanding shares are 100,000, you have a certain earnings per share amount. If your outstanding shares are 120,000, it's going to be less. It's like going out for pizza with 5 people and splitting a pizza, or going out for pizza with 10 people and splitting a pizza. The more people, the less pizza. All right. So stockholder control is not affected. Tax savings, because we get the interest expense, and earnings per share can be higher. Okay. So this is the same discussion of the same thing. Issuing bonds brings money into the company, but does not bring more owners into the company. If you did issue stock, you'd lose more control. Bond financing is better than stock financing. Stock financing increases the number of voters. Okay. Tax expense, interest is deductible. Now, if you issue stock, how does the stockholder make money? If you buy stock, how do you make money in the stock market?
When you sell that stock, given the fact like the stock price went up for that specific stock.
Yeah, and there's a name for that, and that's called capital gains. So you buy at $5 a share, you sell at 13, you had capital gains when you sold the stock. That's one way. What's the second way you make money in the stock market? You buy a stock, how do you make money in the stock market?
Dividends.
Dividends, yes. So Zachary, dividends sort of sound like interest payments, but they're not. Dividends are not deductible. Interest expense is. So if I'm a bondholder, I get my $60 or my $35 once a year. The company can deduct that. If I'm a stockholder and the company pays a dividend of $20, the company can't deduct that. They just pay it. Okay. By the way, if you own stock and bonds and you get a dividend check from one company and you get an interest check from another company, all of that is income to you and you have to report it and pay taxes on it. Okay. All right. Earnings per share, net income divided by number of shares outstanding. The more shares outstanding, the lower the earnings per share number. So bond financing is better because it doesn't impact EPS. EPS is one of those numbers that investors look at, and if it goes down, they don't like it. So, all right, so here we are in the middle of page 47, types of bonds. Okay. Secured and unsecured, term and serial, registered and bearer bonds, convertible and callable bonds. Okay. Oops, sorry. Secured bonds. So these are bonds that have an asset pledged as collateral. Okay. If the company cannot pay back the bondholders, and you'll hear this sometimes on the news, they'll say, oh, this company's not doing well, and on Thursday, their bonds are due. Let's see if they can make that payment, okay? If the bonds were a secured bond, they would have assets pledged as collateral, typically real estate, which would make them a mortgage bond or a sinking fund bond, okay? So what that means is we can't pay you back, but you now we'll sell our factory and you'll get some money back. Okay. That is Sean Connery with hair. Okay. All right. Debenture bonds are the ones we're going to work with. It's a funny name. It's just, they're issued against the general credit of the borrower. So these are the bonds that we're going to study, the corporate bonds we're going to study, unsecured debenture bonds, no assets as collateral. And bonds are rated as, like AAA, low risk, way down, BBB minus, et cetera, higher risk. The higher the risk, the higher the interest rate. Just like when you go for a loan at a bank, the more risk you have, they're going to charge you a higher interest rate. Okay. All right, convertible or callable bonds. So this is the type of bond if it's a convertible, the bondholder can say, hey, you know what? I don't want it to be a bond anymore. I want to convert it into stock. So who would do that? So let's say a company's starting out and they're not doing well. They're not making a lot of money, but they are able to pay their bond interest. And the interest rate is maybe 5 or 6%. Okay. Well, time goes by and the company becomes successful, their sales go up, and consequently their stock value goes up. And so a bondholder may be watching the stock value and saying, I'd make more money if I was holding the company's stock. And so if the bond contract says these are convertible bonds, the bondholder at their discretion can say, I want to convert this into stock. Okay. So why would they want to do that? Because they think they'll get a better return on the stock market versus the bond interest rate. Okay, a callable bond, and a lot of companies have callable bonds features. They would say the company gets to retire or call in the bonds. The company gets to retire the bond at their discretion. Okay, so the company might be watching interest rates and saying, whoa, the interest rates are going way down, but we still have this bond that we're paying 9% on. Let's retire the bond. Let's turn around and issue new bonds at the lower interest rate. So they get to call them in early. Okay. So we have two terms. The indenture means the bond contract. The debenture is the type of bond we will be studying. They're not a secured bond, they're an unsecured bond, and they're issued on the general credit of the company, okay? All right, so over the years, I've come up with a little mnemonic device. Indenture is the contract, debenture is the bond. Okay, so indentured servants were servants that came over to the United States, worked for rich people, and at the end of 7 years, and they paid their passage on the ship. At the end of 7 years, I think they were released and they got like $20 and a rifle or something. But they were called indentured servants because they signed a contract to work for free for 7 years. Okay. Not a perfect system. Okay, debenture starts with a D, like Die Hard, one of my favorite Christmas movies of all time. And in the scene, there's robbers and they come into the building and they say they want to steal millions of dollars of debenture bonds, unsecured debenture bonds. Okay, debenture, Die Hard. So if you haven't seen the movie, I highly recommend it. It's a little bit violent though, not for kids. Okay, so the bond contract or the bond indenture, the board of directors of a company approves new bond issuances. So for example, a company says, we need to raise $5 million. Okay, they would authorize 5,000 bonds at $1,000 par value or face value. Okay, so I have face value written down there. It's also known as par value. Okay, so the bond contract, the bond indenture, includes all the terms of the bond, including whether it's callable or convertible bond. But it would certainly say the face value of the total issuance. So what does that mean, the 5 million? That means if they can sell those bonds, and we use that term sell the bonds, even though it's a loan, if they can sell those bonds, they'll raise 5 million. Okay. And when those bonds are due, they will pay them back 5 million. Okay. Inside the bond indenture, they'll have the interest rate, also called the contract rate or the stated rate. Okay, and it is always, always, always calculated on the face value of the bond. Okay. Now, remember, I told you that bonds are traded on the bond market and the bond's market value goes up and down. So sometimes it's more than $1,000 per bond, and sometimes it's less than $1,000 per bond. But interest is always calculated on face value of the bond. And then the other thing here would be the life of the bond, which would be 3 years, 5 years, whatever. Okay. So if you have a $5 million bond issuance, 8%, $400,000 annually would be paid out, or $200,000 every 6 months. Okay, that's a lot of money. Think about that. That is a lot of money for the company to come up with in a year or 6 months. So the company is gambling like all companies do, right? All companies are gambling that they will be successful. All companies are gambling that they will get a return on their investment that is greater than what they could get at the bank, okay? And so the idea is we will borrow this money and we will pay you 6%, 8%, 4%, and we're going to make more than that. And it's going to be worth it. It's like a teeter-totter. We're going to leverage that money. We're going to build new stores and we're going to make a greater return than we would if we had just put that money in the bank. We're going to make a greater return than the interest that we have to pay you. Okay. But bond selling price is a funny thing. Okay. So we have to think about how this looks. So the bond market is highly volatile. So when a company establishes a bond contract, so let's go back here. If a company establishes a bond contract, they're watching the market rates really, really closely. They're watching the market rates. But when they issue the contract, it's like locking in on a loan. They can't change the interest rate. So they're going to try and get it as close to possible to market. But there's always going to be timing issues from when the bond contract is written and when the bonds go to market originally, and then when they're resold on the market. Okay, but even if it's like a week, which it's probably longer than that because you've got to have the board of directors approve it and all of that. So let's say it's within 3 weeks to a month, the market is already fluctuating. And so what I mean by that is this bond indenture, let's see, is paying 8%. Maybe by the time it actually is sold for the first time on the market has adjusted. And what that means is bonds of similar risk as that company are now paying out 9%, or maybe they're now paying out 7%. And so the selling price of the bond has to be recalculated using present value calculations. Okay, so usually face value of the bond, we're going to assume all face value of a single bond is $1,000. I think there are exceptions to that. So let's say it goes to market. You want your bond to sell at 100, meaning 100%, meaning you sold a bond for $1,000. But in fact, because of market fluctuations, that almost never happens. So the company has to use present value and recalculate the selling price to adjust it to the market interest rate. So they do, and they say, we're going to sell this bond at 97. And that's a discount of 3%. Okay, so our $1,000 bond, we're going to sell at $970. Okay. Or you could get lucky and sell it at 100. So we use language like this bond sold at 97. And what I need you to understand is that means 97%. Or this bond sold at 100. And you need to know that that's 100% of face value. Or you could have a bond, you could get really lucky and sell your bond at 104, which would be 104% of face value. And that means you sold your bond for 1,040. Any questions about that? That's kind of weird. So you have a bond, you knew how much money you wanted to raise, and the market is fluctuating. So you got to build in some cushion when you issue that bond. So bonds are trading all the time on the National Security Exchange. There's the New York Stock Exchange, there's Fidelity, and they'll have, like in this example, Boeing Company is issuing a bond. Its interest rate is 5.125. This is an old bond. Its maturity date is 2014, February 15th. And here is its closing price. And so that means it's not trading at 100. It's trading at 96.595% of face value. Okay, so that would be a discounted bond. On this day, these bonds were traded closing price. And that's how we say it. We say this bond was trading at 96.595. There's lots of bonds out there. I don't have the selling price, but you can see, look how far out some of these go. You got 28, 31, face value 1,000. I picked this up a couple weeks ago. Interest rates look pretty good. Okay, so I'm sure they're higher now, even in the 2 weeks. Yeah.
Do you know where we can get into like the bond market?
Okay, here's the sad news, Alexis. When I first started teaching bonds, I thought, I'm going to go buy a bond. My husband and I, let's just go buy one bond, and just so I can kind of get a little more inside information. So I called up one of the financial firms, Merrill Lynch or one of those, and they said, absolutely, we'd be happy to buy bonds for you, but we require that you buy 10 bonds. That's our minimum. That's our minimum order. And I was like, that's $10,000. Thanks. Talk to you later. So yeah, I do know how you can do it, but and that may have changed, Alexis. So but you can go out to these websites and look at the bonds, and they may have some links, and the rules may have changed now because trading rules have changed dramatically. They used to have all those fees and requirements. So, but I don't like trading in individual stock anymore. I prefer mutual funds. So, all right. So bond basics, what we looked at, face value, par value, 1,000, contractual interest rate, maturity, and the bond issuer. Okay. So we're going to get into these calculations on how we come up with the selling price of a bond. And the way we do it is we look at 2 time streams. We take the present value of the interest payments and we take the present value of the principal. Okay. So, and I will show you how to do that, but not today. So, all right. So let's just look at it from a theory point of view. This company is paying 5% interest. Okay. If the current market rate is 6%, okay, I do this in terms of pretty and ugly. Okay. So the company bond is giving 5% interest. If the current market rate is giving 6% for bonds of similar risk, the company bond is unattractive. It's an ugly bond. It's paying 5, but the market's paying 6. So the company cannot sell its bond for 1,000 because nobody's going to buy a $1,000 bond that's paying 5 when they can buy a $1,000 bond that's paying 6. So they do a present value calculation and they discount their bond. So it's going to sell for lower. So when a bond sells for lower than par value, you know that the current market rate is higher than the bond rate. And what that does is it's not an arbitrary amount. It's a calculation so that it equals the market rate. So that if a person buys it at $950, still making 5% on $1,000, it'll work out to 6%. Okay. However, the opposite can be true. The company's paying 5%, but the current market rate dropped to 3%. That means the company has the pretty bond, the beautiful bond. Okay. So in order to adjust to market rate, they charge more for the selling price of their bond because the company's bond is more attractive. And then the person buying the bond pays more. When it becomes due, they only get $1,000 back, even if they paid $1,040 for the bond. And it adjusts, and that makes the adjustment to the 3%. All right. Show you how to do that. Okay. All right, let's stop there. And I want to give you, let's see, do I want to do one more thing? Oh, let's do one journal entry before we go. Okay. Okay. So I want to issue bonds and I want you to calculate interest expense. All right. So issuing bonds, accruing interest, paying interest, and retiring bonds. Okay. All right. Let's see if I can get to the discount. All right, I need you to do something for me since we're all here today. Where I have red here, I need you to make that correction. So, okay. So turn in your course pack to page 48 and make these red corrections. Okay.
Did you say 48?
Correct. All right, so at the top of page 48, your number I think says 1,000. That should be 100. And your words here say semi-annually, and I want it to say annually. Okay. And then I need you to change these dates here. Okay. Any questions? You guys good? All right. Can I change the slides? Okay. So we're going to work with the first column here on this spreadsheet. Okay. So you have that open on page 48. So we're going to look at these issuances and we're going to say, what happened here? Okay, so on January 1st, and I don't have a space for you to write this in because I'm just giving it to you on the spreadsheet. Yeah, okay. So stay on page 48 in your course pack. On January 1st, Misha Inc. issues $100,000 5-year 10% bonds at 100. That means they were issued at face value. Okay. Interest is payable annually on January 1st. The entry to record the sale is debit cash, credit bonds payable. And you see that in that first entry there. Everybody see it there? Ah, right there. Okay. Debit cash, they got the money. They sold the bonds. And that's kind of a, that's how they say it in the bond market. They sold a bond. But we know it means they took out a loan. Okay. But that's just how they do it. Okay. So you'll never see one that's face value, but I want to walk you through it because I think it sets the stage for the other. Okay. On January, so next entry, prepare the entry to record accrual of interest on December 31st. Okay. They don't pay it till January 1st, but because in this company, they publish financial statements December 31st, they have to accrue it. Okay. Debit interest expense. Credit interest payable. I think I have the words bond interest expense and bond interest payable there. Okay. Next one. One day later, they issue payment checks for interest. 10% on 100,000 they're paying. So they're clearing out that payable and crediting cash. Okay. And then this will repeat for 5 years. And then in 2006, after they do their last interest payment, they will also pay back the bond. Okay, all right. Debit bond payable, credit cash. So what is the total? Sorry, what is the total cost of borrowing? Oops, that should say 10,000. Messed that up. I'm telling you, when we changed textbooks and went to 10,000 times 5 years. Yeah, that's it. Okay. That really, all right. 10,000 for 5 years is 50,000. That was the cost of borrowing. But when they're done, it's 50,000 plus another 100 that they have to pay back. I don't know about you, but that's kind of shocking to me. You borrow 100,000 and you pay 50,000 interest. Okay. All right. I'm going to stop there. All right. Stop sharing. I want to give you 10 minutes to be in your groups and talk about your contract and your who's doing what. So, all right. Okay. Do you guys remember your teams?
Yes.
Thank you. Okay, I'm going to put you into breakout rooms and I'll stop recording.